Okay, good day everyone. My name is Nick. I'm the author of StockInvesting360. The website StockInvesting360 provides stock investing information, tricks, knowledge also based on various things that an investor should look for. I'm a growth and long-term investor, so I'm more interested in the financials and the fundamentals of companies, and I want to invest in them long term. I'm not a day trader, and I'm not really using technical analysis to decide when to buy a stock and when to sell it. I prefer to look at financial statements and decide if the company is meeting my investing criteria. So I've provided a couple of stock picks recently. I normally look for growth stocks that are profitable, that have a nice balance sheet. Some, you know, I look at the current ratio. I also look at the shareholders' equity. I don't like to invest in companies that are in serious debt trouble. So obviously, I look at the balance sheets to make sure that companies I want to invest in are financially sound. I also look at the valuation and the growth potential of the companies I want to invest in, and I also consider the analyst opinions because the analyst opinion will have an impact on the general feeling of investor towards the stock. So normally, it's not always the case, but normally when analysts have a positive opinion of a company, it normally means that the general feeling of the investors will also be positive, and you can expect the stock to have a positive pattern in terms of price going up. I've been asked by a couple of viewers and members of my site to provide sometimes stock picks and stock reviews of companies that are growth stocks, yes, but maybe not, the usual growth stock that has a huge growth potential, but also that provides some kind of a defensive aspect in terms of, diversifying a portfolio to have some stocks that do have a business plan that is more apt to resist a downturn in the economy. That's what I tried to do with that stock pick, Anthem Inc. As we will see in the following slides, it's a company that is operating in healthcare benefits plans. So obviously, even if there's a downturn in the economy, we can expect that the healthcare plans will still be something that will be of interest to large and small employers. So basically, Anthem Inc. is trading under the ticker ANTM. Before we go any further, I have to say that I do own shares of Anthem Inc., so I'm a shareholder. So this video is not a recommendation to purchase or sell shares of Anthem Inc. Any investors interested in this company should conduct its own due diligence, have a look at the financial statements, and then you make a decision whether this investing opportunity fits your criteria and if it makes sense for you. I do provide a couple of screenshots from financial websites and information on the stock, on the financial statements. So I take these information from Yahoo Finance and Morningstar. So let's go have a look at Anthem Inc. On the second slide. So it's Anthem Inc. profile. It's not a small company. It has a market cap of almost $60 billion. Uh, it's headquartered in Indiana, so it's in the U.S. It's trading on the New York Stock Exchange under the ticker ANTM, as we have just discussed on the previous slide. And in a nutshell, it provides healthcare benefit plans to large and small employers. So basically, employers want to provide a health plan to their employees. They can go to Anthem. There's other players in this niche, but Anthem is one of them. So that's the type of services it provides, and that's how it generates its revenues. So yes, if there's a downturn in the economy, we could expect that some companies will reduce their payrolls, so there will be an impact on Anthem revenues, but still, the company will still be able to generate revenues because it's not they don't sell a product that is a consumption product that people will decide to cut their expense. Companies that are providing this to their employers will keep providing this during a downturn in the economy. So it's kind of a defensive stock, and being in the healthcare industry, uh, can be said that it's going to be less impacted by a recession. Let's say that something happens in 2 years from now, the revenues of Anthem will be impacted, but probably not as much as other companies that are in the retail or stuff like this. So when we look at the stock movement since 2001, we see that the stock has gone up. So that we never make a decision to invest or not in the company because of the graph, the chart, but still see that there is some kind of a momentum, an interesting momentum for people that want to see the price of their shares go up. And we will talk about the price earning ratio, earnings per share in the following slides. So, if we look at profitability, first criteria that I like to look at is the company making profit. Is it profitable? Does it have a profitable business plan? So in that case, well, we need to look first at revenues and net income. So we see that net income have been positive for the last 10 years. So that means the company is profitable. If we look at the revenues are going up from 2007, revenues of 61 million dollar, a billion, million billion dollars to 84. So it has an average rate of 3.7 percent per year. It's not a lot. It's not a lot. We growth investors will try to find companies that are providing numbers in the double digits. But again, we're looking at that stock mainly, well, because it's a defensive stock, but it also provides a potential of growth. So the net income are in $1 million. So sorry, here it's in $1 million, right? 61,168. So it's, yeah. Net income here we can see that's normally I'm not interested in these type of companies that are seeing the net income, so basically the profits, go down. As we move from 2007 to 2016, profits went down even though revenues went up. So that means that the operating costs have been higher. You can see here operating margin has been reduced. So that's something that is of a concern normally if you want to invest in growth companies. But thing that I like about this company is if we look at the amount of shares that are trading, the amount of shares that are trading have been reduced by more than 50% from 2007 to 2016. That means the company is buying back its share. So that means that if you own a share and the company is buying shares from other investors, then your ownership percentage is growing. Then by default, the value of your share should grow. So that's what the company has done. If we look at the earnings per share here, went from $5.56 of earnings per share that are trading to 921. So the company has managed to generate revenues, value to its shareholders by purchasing back its shares. So that's what we could expect from this company: increasing revenues at a slow but consistent rate, and net income consistently in the positive, and EPS that are mainly growing. There was a little dip here, and then it kept marching up again. So that's how the company is being able to increase the share value of its for its shareholders. So I'm fine with that strategy as long as they're making profits and they can use this to buy back their shares. We can see potential to see the earning per share grow, and by default, like I said, the price per share. So profitability, it's fine. It's not super, but it's not too bad for a defensive stock. Definitely not. Now, if we go see the balance sheet, so basically the balance sheet, the way they presented it is not that good. But I went into their documentation and I've calculated for 2016 a current ratio. So basically, current asset divided by current liabilities, 2.3. So that's very good. So there's 2.3 times more current asset than current debt. So the company is able to pay its debt, and because of its cash and cash equivalent, it has been able to purchase some shares back, which is generating value to its shareholders. If we look at the shareholders' equity growth, that's something too I like to look at. So it went from 23.8 million to 25.1. Well, 23,800 millions to 25,100 millions. So that's in the billions. And we see a growth of 1.3. That's really small. But again, if you are using your money to purchase shares, money is leaving the company, so it's reducing the shareholders' equity. So there's that's the way that this company has decided to grow the value of its shareholders' worth is by purchasing back its shares. So it's normal that it will impact other aspects of the business, such as the shareholders' equity. So all in all, the balance sheets looks fine to me. It's not scary. It's well financed and it should be able to sustain some rough times if need be, because it has a nice current asset ratio compared to current liabilities. Other thing we like to look at, valuation and growth. So basically, the one share is currently trading on December 13th, 2017 at $232.12. So that's quite expensive, but you have to look at what you get in return. So basically, at that price with an EPS of 11.08, the price to earnings is set as 21.02. So we around 20 is close to average for the stock markets. Sometimes it's a bit lower than 20. We've seen that the company is generating value to its shareholders by purchasing back its shares. So less shares means that the profits will be divided by a lower amount of shares. So EPS is growing, so that's fine. And if we look at the growth estimates that's provided by the analyst, an average of 12.38% per year for the next 5 years. Those are forecasts, so they'll have to be, we'll know about them in 5 years when we'll have the financial statements for the next 5 years. We don't have them right now, but I still like to use it because this is average. There's many analysts. Some are positive, some are negatives, but that's an average. So 12.38 seems to be interesting in terms of a defensive company that can provide a 13%, 15% growth. That's interesting. Now, if we look at the analyst opinion on this stock, first of all, we look at there's about 19 analysts tracking the stock. The average recommendation is 2.1, so it's basically a buy. So we like to see a strong buy, but buy is it is what it is. It's not too bad. And we look at the current price is slightly higher than the average target price. So does that mean that the stock will stay flat for a while, or can we expect some analysts to raise their stock price target? We'll have to keep an eye on this company. If we look at revenue estimates, sales growth this year and next year. So it's growing at 5.2, 3.4. So if we go back to our profitability, we had from 2007 to 2016, we had a 3.7% per year revenue growth. Now the estimate is between 5.2 and 3.4 in 2017 and 2018. So it means companies keeping the same growth rate. It's not exceeding any other good growth stock, but it's still a revenue growth. And coupled with the fact that it's purchasing back its share, we can expect a 12.4% growth of the company's value. That's fine. So if we look at the price target, if we look, one thing that I forgot to look at is the PEG ratio. So people that are familiar with the PEG ratio is basically you divide how much you pay per each dollar of profit, 21.02. So it's you obtain that number by dividing the stock price by the earnings for each share. So you get about 21.2, and we are expecting an average growth rate of 12.4%, 12.38% per year. So you divide 21.02 by 12.38, you get 1.7. So below 2, something that we like to see around 1. Lower than 1 would be awesome. That would be a nice find. But companies that are solid will normally trade with some kind of a premium. In that case, Anthem have shown that it's growing its EPS consistently. It's making a profit. So we have to expect to not be below 1, but we are below 2 in terms of PEG ratio. Again, we can expect that this company is considered a defensive stock. So it could complement, it could be a nice complement to a growth portfolio with a couple of companies like this that can provide some kind of stability when rough times will come. So Anthem Inc., ANTM, I guess meet these criteria. So I hope you've enjoyed this. I tried to find stocks like this and hopefully better ones too with higher growth potential, and I put them on my YouTube channel. So you can also visit my website, StockInvesting360.com. There's some investing modules that you can download. You can also become a member and have access to my portfolio and stock reports. So I'm providing evaluation of stocks on the companies that are on my portfolio. And again, I invest with the idea of investing long term on growth stocks. So I hope you've enjoyed this, and visit me later on as I will put some other stock picks and reviews for you guys. Thank you. Bye.